There's been a lot of talk recently about equity market concentration, and many investors have been considering whether this poses a genuine threat to portfolio performance. In this video, I'd like to talk to you about the potential consequences of high equity market concentration. My name is Plenderleith, and I'm an investment consultant at Quantum Advisory. Stock market concentration has been increasing significantly over the past decade or so, and this follows a sustained period of outperformance from the Magnificent Seven US technology stocks. In fact, market concentration is currently the highest level since the 1960s, and this was back when the likes of IBM, General Motors and GE were the world's largest companies. Within the US market, the largest 10 companies currently account for more than 30% of the S&P 500. And this compares to just 16 to 18% just 10 years ago. The global market has become more concentrated to the US, and particularly the US technology sector over recent decades. Technology stocks have performed extremely well over recent years, and this has been warranted as we've experienced significant technological developments which have made the largest tech companies extremely profitable. Due to this strong performance, the allocation to the largest companies has increased significantly. In practice, this increase in equity market concentration means that the larger stock allocations within investors' portfolios may have increased significantly, particularly where large equity allocations are held. So what potential problems does this pose to investors? Well, I suppose one of the first problems that springs to mind is a potential lack of diversification. Large companies such as Meta, Nvidia and Tesla are extremely sensitive to new ideas and investor sentiment. And we've seen this in action over recent months as investors have re-evaluated the prospects of these companies to turn generative AI developments into profits. Despite delivering strong returns over the past couple of years, these large tech companies have experienced significant bouts of volatility. This increase in volatility could be an issue for investors that need to draw on their portfolio. Such investors may prefer lower volatility investments despite potentially lower returns to avoid the potential of having to draw on these assets during times of market stress. A second potential problem of higher equity market concentration is that history tells us that high concentration does not last forever. Times of increasing equity market concentration, as we've experienced over the past decade, are typically characterized by a bull market, with the largest companies performing extremely well. In the past, when concentration levels have reached the levels we're currently experiencing, a bear market has followed, whereby some of the largest companies perform poorly. If history is a good predictor of the future, then we could see the current concentration unwind as the Magnificent Seven reach the maturity phase of their lifespan, or they become somewhat less profitable earlier than expected. Timing the peak of equity market concentration will be extremely difficult. Even if it proves that these stocks are overvalued, it could prove to be detrimental to investors that underweight these stocks in the event that they continue to be primary drivers of stock market performance. Even if concentration begins to fall, we could see a rotation from the technology sector to other sectors, meaning overall equity returns remain attractive. So, should investors make any changes to their portfolios? Well, I suppose a good starting point would be for investors to understand their exposure to these stocks in the context of the wider portfolio. Investors with relatively small allocations to equities and diversified portfolios may be happy to make no changes at all. The specific stock allocations within such portfolios will be relatively small and are unlikely to have a large impact on overall portfolio risk. However, portfolios with a greater allocation to equities will be more exposed if the current high concentration unwinds in an unfavourable manner. These investors may wish to consider weighted indices or even active management to reduce concentration, or they could look to introduce larger allocations to other asset classes to increase overall portfolio diversification.